Hello, I'm Melanie Risdon with the Western Standard. Thanks for joining me for this edition of In Focus. Homeowners, this one is for you. This evening, we're going to take a close look at the several Bank of Canada interest rate hikes over 2022 to the tune of about 3.5% so far this year, and how those rate hikes, although designed to slow inflation, are directly affecting current homeowners and those who are looking to get into homeownership in the near future. Joining me this evening is Danielle, a mortgage broker for 16 years and owner of Mortgage Line in Calgary. Danielle, thanks for joining me.
Thanks for having me.
Now, according to a former Bank of Canada governor, the current head of Canada's central bank increasing key interest rates as quickly as he did was the right decision. He said the rate hikes needed to keep inflation low came too slow. And according to an opinion piece in the Financial Post, the Bank of Canada should now pause rate hikes and reflect. Just curious what your thoughts are on the idea behind these kinds of rate hikes being how we're going to control inflation. Do you want to start there?
Yeah, that's a good place to start. So essentially, I mean, the basic idea is that if we're charging more for interest rates, or the government is charging more and money is more expensive to borrow, then typically we would see people borrow less of it, which then reduces and curbs spending, which then brings down inflation. So that's kind of the general idea behind it. Obviously, as mortgage brokers, we would love there to be some regulation on maybe outside spending, credit cards, things like that. But of course, mortgages are much more easy to regulate for the government. So that's where they tend to do all of their regulations. So when they are increasing the interest rates, again, idea is to curb the spending, which helps with inflation. So it is the right idea. I was recently listening to Chief Economist Dr. Sherry Cooper with Dominion Lending, and she had the exact same sentiment, which is these rate hikes needed to happen. The stress test needs to remain in place in order to help curb that inflation.
Mm-hmm. Now, looking at these rate hikes, just having a kind of snapshot over the last kind of year and a half, those interest rates stayed the same for quite some time. Looks like for a good chunk of last year, they didn't even move. But then we saw an increase start to happen around March of 2022, and then it has been a steady increase since then.
Yeah, so this year has been one of the largest increases we've seen in a short term. Obviously, people are feeling it. Home buyers and homeowners are feeling it. So about 3.5% increase kind of since the start of this year, which translates as far as mortgage rates go. When we're talking about home ownership and payments, between lenders, and on average about 3.7%, we've seen interest rates go up from the start of this year until now. So as you can imagine, that has greatly affected home buyers and homeowners.
Mm-hmm. And I mean, I think intuitively, most average people would look at it and say, well, how are we helping inflation by making the cost of living even more by ramming up the interest rates and then making payments for mortgages more expensive when everything else is more expensive, the cost of gas, the cost of food. How are people going to survive this? So let's kind of map out how these rate hikes can and will affect current homeowners.
Yeah, for sure. That's a great question. So I always like to kind of divide it between home buyers and homeowners. It's going to affect people differently. As a homeowner, you will, if you're on a variable rate mortgage, so keeping in mind a variable rate mortgage is the type of mortgage where as the prime lending rate increases or decreases, your interest rate that you're being charged by your lender will increase or decrease, and therefore your payment may, depending on your product, increase or decrease. So those people are the ones that are really feeling the changes in the interest rates here, because we're seeing on average, and to give you a rough idea, the prime lending rate changed October 26th. So the day before October 25th, as compared with October 26th, homeowners would have seen, again, on average, about a $30 per month increase for every $100,000 of mortgage balance. So if someone has a $400,000 mortgage, you're potentially seeing $120 a month increase on your mortgage, which is a lot for some people. And obviously it just goes from there. The higher the mortgage, typically you're going to see a higher increase. As for an actual home buyer, so let's say you're out there and you're in the market for a new home and you're house hunting, which October 25th, again, that same date to October 26th. So we're talking overnight. When we're talking about people purchasing, they could actually spend $25,000 less on a new home than they could the day before. And again, that's because as interest rates increase, that stress test rate that the government has set that says, hey, anybody who's qualifying for a mortgage, we need you to qualify at a higher interest rate just to make sure if in the events rates go up, you can still make your payments. So as that goes up, obviously the amount you can spend goes down. So we're seeing home buyers affected in one way with their mortgage payments, and homeowners affected in one way with their mortgage payments, and home buyers affected with how much they can actually spend while they're house hunting.
Right, of course. And so this has been, quite a large jump in the span of less than a year as far as interest rates go. So somebody that, say, we're not looking at variable rates, somebody who's locked in, I know for us, we have a locked in rate. When it comes to the renewal of that rate, or the renewal of that mortgage, we're going to see a big jump in interest rates from what I'm pretty sure I have a mortgage that's probably locked in under 3% right now, and when that comes up for renewal, that's going to be quite a big jump to the interest rates of today. So what can you say to homeowners who are potentially facing that? Is there any strategies? Is there anything they can do?
Yeah, for sure. So, I mean, actually, something I've implemented myself personally, and I'm in this every day, is I made sure as soon as these rates started going up, even before actually, but as soon as you can, changing your payment frequency is a great example. So people who are paying monthly, if you can afford to pay accelerated bi-weekly, or if you can afford to increase your payments at all during this time while your rates are still lower, that's going to help bring that principal balance down. So when you do come up for renewal at the end of the day, hopefully your mortgage balance, or not hopefully, it will be lower than what you were expecting. So hopefully that combined with the higher interest rate will help offset a little bit of that increase for you. So kind of getting that mortgage paid down as low as you can before you're coming up for renewal is a great option. We've been talking to a lot of clients who are taking some of their lump sums that they've had to set aside in savings or GICs, things like that, putting those down against the mortgage to also, same thing, reduce that mortgage balance.
Right, because and we'll just clarify too, any of those excess payments that you make or those lump sums and stuff go straight to the principal rather than the interest, correct?
100%. Yeah. So that directly brings your mortgage balance owing down. So not only does it save you on interest over time, but like I said, because the balance is going to be lower when you come up for renewal, your mortgage payment should technically, be lower because that mortgage balance is lower, obviously lower than what it would be if you hadn't paid it down. We're still going to see increases. I mean, we'd be dreaming if we didn't think we were going to see increases on renewal. We typically do anyways, but now that combined with higher rates, we're definitely going to see increases, but we can offset it a little bit by prepaying. And then something else we can do as well is when you're coming up for renewal, it's really important to discuss options. Don't just sign on that dotted line. So it's really critical that you're looking at all of the options, of which one is extending out that amortization. So maybe lengthening that time of your mortgage, that amortization, that might lower your payments by even a few $100s a month to help offset that increase in interest rate. So there's always options there. So just make sure you're talking to an expert so that you can explore all of those options. The last thing we want people to do is, sign on a dotted line, go into a fixed rate when, to be honest with you, I'm sure you're going to ask me, but we're kind of recommending variable right now anyways. We don't want you to be stuck in a mortgage that has high penalties, high fees that you can't redo after you sign.
Right. Yeah. And you know what, for a lot of new home buyers or people who are looking to buy, a lot of this terminology may not even make sense for amortization. So amortization is for how long you've had your mortgage for. And so what you're saying is increasing that amortization when it comes to renewing your mortgage means instead of you paying it down now, maybe there's 10 years left owing on it, but you extend it to another 15, therefore kind of breaking up that increase that would be kind of hitting some people hard. We're talking, in some cases, $600, $700, $800, $900,000 dollars more a month in a payment. you
Yeah.
can kind of offset that by kind of re-lengthening how long you're going to pay that mortgage down for.
Exactly, exactly. Extending out that length of your mortgage. So we have what's called a term. Typically, you see like a 3, 4, 5 year term with a mortgage, but that amortization is what your payment's based over. And so the
Right.
standard amortization is 25 years, but depending on your mortgage, you may be able to extend it out to 30. So yeah, your example is perfect. Someone who maybe has 10 years left might want to consider extending out to 15, 20, 25, just to kind of combat the increase in interest rates here for the next little bit. And then when rates come down, you can always, again, prepay that mortgage to offset that longer amortization and pay it off quicker again.
Well, and I know, again, for sort of newbies coming to the table and trying to figure all of this out, it can be a lot to try and process. So I know what was helpful for me early on was meeting with a mortgage broker. Even yourself, Danielle, you're full of all sorts of options that can really help work out a program or a mortgage or a strategy that is best suited for sort of each individual's situation.
Yeah, that's kind of what we pride ourselves on as mortgage brokers, is that we are listening to our clients. We're asking you all of the right questions to take into consideration. What are your plans? What are your goals? Do you want to pay your mortgage down quickly? Is it a rental property? So all of these questions are going to come into play. How long do you want to own this home for? That's going to help us decide, okay, do we take a shorter term, a longer term? Do we go fixed? Do we go variable? Are you comfortable with payment changes? Are you a riskier investor, or are you more conservative investor? So all of these factor in. And if you're not being asked those questions, then that's kind of a red flag. You want to make sure you are being asked all of these questions so that that mortgage is being properly set up for you.
Mm-hmm. And again, like you mentioned, instead of signing on the dotted line. So of course, when your mortgage with a bank comes up for renewal, you get sort of mortgage renewal documents, and it's sort of, here's our standard rates, and sign here. And it's typically for a similar term to what you've had, or you can select the terms, but without really understanding the difference in how quickly that's going to be paid down if you switch to your biweekly payments, or even understanding like, hey, I can't afford this mortgage payment at this rate anymore. Having that conversation about reamortizing or extending that, those conversations are really incredible. And speaking to somebody who knows what they're doing is obviously very helpful in a time like this, where there's a lot of homeowners and new buyers that are really struggling to figure out. They're almost panicking. How are we going to manage with interest rates this high?
Yeah, and we are definitely seeing some panic. We're fielding calls from people, my rate's going up to this, my renewal's this, I can't afford my payment. So we are going through all of those strategies consistently on a daily basis with multiple people right now. So, if anyone's out there thinking they're the only one who's panicking, you're not. And right now, having that conversation with your broker before you're coming up for renewal is a really great place to start. So then we're getting ready. We can sometimes even renew a mortgage early, and it's worth it because we can lower payments before rates go up. So there are tons of options out there. Nobody is expected to sift through them all by themselves. So definitely, reach out, chat with someone, ask the questions, have them ask you the right questions and provide you some guidance.
Right. Now, we had a rate increase. They did start in March. So we had a rate increase in March, then in April, June, July, September, October. The next expected announcement is December 7th. And as I mentioned, some are calling for the Bank of Canada, just hold your horses. Let's just kind of keep it where it is right now. What are your thoughts on that?
Yeah, so there's mixed reviews. You're going to see some people who want, there to be that hiatus, and some that are saying, no, we still need to go a little bit further to kind of curb this inflation. Bottom line is we're probably going to see another increase in December. Likely though, hopefully around a quarter point. So not as much as people were maybe anticipating. We just saw that half point recently, a quarter point December. And then the talk is potentially between 0% and 0.5% next year. So nothing hopefully major next year. And we might even see them take that hiatus next year. But yeah, I would say it's safe to assume that come December, we're probably going to see another quarter point increase here.
So what kind of rates are we looking at now for, say, like a regular 5-year term, or give me some idea of where we're sitting. And let's talk historically where we've been.
Yeah. So, if we were to say, I picked a few numbers here for you just to kind of see. So in 2000, let's say in January of 2000, so we're talking about 22 years ago, we're looking around, over 8%, about 8.34%, 8.34% on average for a fixed rate and 6.5 for a variable.
Okay.
Fast forward to, January of 2022, this year, we were at 3.44% for a fixed and under 2% for a variable.
Right.
So that is a drastic difference. And one thing I always like to kind of clarify for people is anybody that's only really relatively new to the housing environment within, let's say, the last 5 years, let's say first-time home buyers, for example, they've come into a time where over the last few years, we've seen an abnormally low interest rate. And that's not normal, or normal, quote unquote, for what we've seen. Historical averages are kind of that mid-high 4% range. So where we're at now might be a little bit higher than average, but not much. And where we're anticipating that we're going is kind of in that end of 2023 to 2024, we're going to start to see those fixed rates come down, but we're still thinking we're going to end in that mid 4% range. Mm-hmm. So just to be kind of upfront with everybody, that mid 4% range is quite reasonable. But yeah, today, October 2022, we're around 5.64 on average for a 5-year fixed, and we're around 5.5% average for a 5-year variable.
Gotcha. So speaking then to, like you said, millennials, new home buyers, those who have yet to get into home ownership, what kind of strategies do you want to point out or have them focus on as far as making plans to get into home ownership?
Yeah, so I would say one big thing is really, this word stands out to me, is don't procrastinate. Getting into the market is better than sitting and waiting and waiting and waiting. We saw, just to give you an example, home buyers who went out house hunting September of 2021, as compared with today, they're able to spend $120,000 less on a new home on average, just because of where interest rates started and where they've come with that stress test rate. Nice. For people who are waiting for the market, trying to time house prices and interest rates, they actually outpriced themselves out of that style of home or home that they wanted just by waiting. So I would encourage home buyers to, just go for it. You can't time the market perfectly. We are going to see rates come down likely in 2023, into 2024. So, we kind of talk about this all the time, but fixed or variable, which is better. And right now, if you can ride out the variable rate and you're comfortable with it, then you could purchase a home, get into the market, get your equity build up, right, as house prices are continuing to remain stable or possibly even increase, but you're paying down your mortgage and not somebody else's. And then when you do come up for renewal, like we mentioned earlier, or when we're seeing these rates come down in 2023 and 2024, that's when you might call your broker back and say, okay, should I lock in now to a fixed rate? So at least you're not missing that 1.5 and 2 years of home ownership equity buildup and debt pay down. So I would say don't procrastinate is one of my biggest strategies for millennials or anybody really that's just trying to get into a home.
Yeah, I'm sure it's probably changed the focus for new buyers as well. And when we're talking about what they can qualify for, I know for quite some time here with the very low interest rates, apartments, condos, things like that were sort of just kind of crickets, right? Like people were sort of skipping over those because the interest rates were allowing them to be able to get into homes with yards and garages and things like that. But are we likely going to see a difference there then?
Yeah, absolutely. And we already have. So, housing markets are showing that condo purchases and townhouse purchases are steadily increasing. They've even jumped a little bit, some would say. And that is exactly like you said. It's because that stress test rate has increased so much. It's affected home buyers' qualifying ability. So really that's the price point that they're able to get in at. Whereas before we were, 100, 120,000 more, you could get into that single family home. So yes, the condo market, the townhouse market, we're definitely going to continue to see a rise in that market. Mm-hmm. And, just for anybody that's out there, supply is still low. I mean, we see it all across the board, but as it pertains to the housing market, supply is low and there's still that demand. And Calgary is a phenomenal city, speaking, specifically to Calgary. We are significantly lower priced than the Vancouver and the Toronto, and we are much more affordable. We've got tech companies setting up shop that are going to create thousands of jobs over the next couple of years. We've got the oil industry. Our economy is going to remain strong. So we don't really see house prices coming down that much per se. So what does that mean? It means that if you're going to wait to time interest rates, but rates are going up over the next year and a half, and house prices are remaining stable, you're going to continue to outprice yourself and continue to lower the amount that you can spend as a house hunter.
Right. Well, and speaking of, supply versus demand and the fact that that condos and apartments and whatnot were sort of low demand before, would you say there's sort of ample opportunity for the pickings there at this stage?
Yeah, I mean, I would say there's definitely a decent supply of condos out there and townhouses out there. And so that allows home buyers to be a little bit picky and to make sure they're getting what they want in that price range. But again, coming back to what you mentioned before, as far as strategy goes, I would say just get into the market, right? If a condo is where you're going to start, that's great. It's a starting point and you can move on from there down the road and move up as interest rates maybe come down and as your incomes increase and as time goes on. But again, at least you're building up that equity. You own that asset and you're paying down your own mortgage, not someone else's.
Absolutely. Yes. I would say strategy wise, getting out of the rental market, getting into home ownership, you will always be putting money back into your own pocket at the end of the day.
Yeah, exactly.
All right. Well, my suggestion for those of you that are looking to purchase something new or even have questions, you're a little bit concerned about when your mortgage is coming up for renewal. And hey, you can always talk to a mortgage broker about renewing early, if that makes sense. I mean, there's times when it does, maybe times when it doesn't. But I think the key for advice from me and, from my experience with homeownership is talk to a mortgage expert. Talk to somebody who can walk you through all of these different scenarios that may make sense for you.
Absolutely. Relying on an expert is critical. Yeah.
All right. Well, Danielle will include some contact information for you as well. But if you have been working with a mortgage broker, highly recommend make some phone calls, get some questions answered, make sure that you're well advised before you make any moves, but also, in preparation if you are looking to purchase a home. Thanks, Danielle, for joining me and sharing some of your insights into this this climate that we're moving through. Again, millennials probably not used to seeing interest rates like this. Some of us were alive when interest rates were much higher. So I guess we should be thankful that they're nowhere near where they could be.
Exactly. And thanks, Mel, for having me. I really appreciate it.
All right. Thank you.
You can become a Western Standard member for just $10 a month or $99 a year for unlimited